After a long gap, we got Sumeet Nagar, market maverick. He loves to buy some of those mid and small cap stocks. That's the pond where he ideally fishes, which is the semi-large cap and the mid cap space. That's the mandate which he runs in terms of managing money and managing and investing. Sumeet, fantastic to have you back. Hope all is well at your end. Thank you very much for joining us. Sumeet, I've never seen this kind of a divided world. The economists are saying that this is the worst they've seen in their living history. That's IMF for you, which is talking about the worst recession in last 100 years. But if I look at markets, markets are on the other end of the spectrum, which is that all major markets are up more than 35 to 40% from the recent lows. And guess what? S&P has registered its biggest winning streak in last 50 years.
So, I think if you look at the markets, I think in the first few weeks when, the COVID situation sort of came to the fore, you saw a very sharp response to that problem. And I think it happened globally. It also happened in India. I think there was an indiscriminate selling everywhere without sort of seeing how much impact there would be, which sectors or companies would be more impacted versus less. Pretty much everything had corrected with the same brush. And I think over a period of time, I think people started to realize two things, right? One is that, the impact would be finite, and it has an end to it, right? So once you find a therapeutic cure or you find a vaccine, essentially the medical problem comes to an end. You still have to resolve the economic problem. So I think that on the one hand, and on the second is that it just sort of brought forth unprecedented level of monetary and fiscal response to it, both globally as well as locally. And I think once people sort of started to see that and see that there was no liquidity-related problem, the markets went freezing up. And so essentially, the markets are functioning, the economy is functioning, it will sort of sequentially keep coming back. And so you've seen the response of that coming into the market. Whether the level of response and how quickly it has come back is justified, I think it's open for debate. But by the same token, the level of decline up front that happened, especially in India, I think in March you saw a massive decline in Indian markets when you only had a few hundred cases in the country, right? So I think the initial response was also disproportionate, and perhaps and that was surprising. And compared to that, I think the revival back in the market is also a little bit surprising. But I think given the first, it's probably not as surprising. I think only thing that is up for debate there is how quickly the rebound happens, and is that justified?
Sumeet, if one works with an assumption that earnings recovery will be sharper and stronger than what was anticipated, let's say 6-8 weeks ago, so then what happens when earnings will actually come back? Some would argue that markets have already run up in anticipation of earnings, and when the real earnings recovery will start, the markets are unlikely to forge forward.
Yeah, so I think the markets are forward-looking. So I think they've seen that, from starting from the third week of April, sequentially you've seen all the leading indicators sort of picking up from that bottom, and so I think the markets are forward-looking, and they anticipate that things are continuing to improve, and so that's what is getting priced in to some extent. If that recovery and pace of recovery continues, I think the markets can hold their own, especially given that there is unprecedented amount of liquidity that's come into the global markets, and that has yet to come through to the emerging markets yet. And I think if you see, I think in the March we saw a fair bit of foreign money leaving from the Indian markets, and that has yet to fully come back.
Sumeet, last time when we spoke to you about a year and a half ago, you were slightly skeptical about investing. Your view was that the small and the mid-cap space, even though the correction had kicked in, was still trading above their mean valuation, and you were not raising fresh capital from your clients to deploy more money. What's been your portfolio strategy in this crisis? Have you raised capital? Have you deployed more capital? Where are you picking up the spots? Sorry, I'm combining a lot of questions into one.
So I think this is a stock picker's dream, right? So you've seen a fairly steep correction in the market in the month of March and April, and I think as a result, you've seen that for many companies the prices came below the intrinsic value, after a long while, and that's usually a good environment to be able to invest, to find good opportunities, invest in them. I think what sort of made it even more challenging is that in this environment, I think the intrinsic values of companies also got impacted, right? So you have a dynamic situation where the price is getting impacted, but also the intrinsic value is getting impacted to some extent for companies. And so you have to evaluate which are the companies where you're seeing a very limited impact or to no impact on their intrinsic value, and correspondingly, maybe the price has fallen a lot more. And those are the great opportunity for you to invest in. And so I think over the course of last few months, I think we've been able to find several opportunities like that. And that's the reason why we thought it was an opportune time to actually take in more capital. I think, as I've mentioned to you in the past, in our small cap oriented strategy, we hadn't been taking in money for quite some time now. And given the steep correction, which brought valuations to fairly attractive level. I mean, just to give you some data points, in the end of March and beginning of April, valuations in the small and mid caps, you were seeing were the lowest that you've seen perhaps in the last 15 plus years. So if you think from the perspective of, let's say, price to book or market cap to GDP, I think these valuations were the lowest we've seen either since financial crisis or some cases even below that. And so I think in an environment like that, as a long-term value investors, you want to be able to take advantage of those. And so that's what we've sort of tried to do over the last few months.
Right. So Sumit, at a time when demand is getting crunched, interest rates are getting lower, even for that matter, supply is going to be challenging. How does one really figure out the intrinsic value? Because intrinsic value is a function of a normal business model. These are not normal business conditions. So how does one ascribe or find out the intrinsic value?
Yeah, that's the $1 million question, right? So I think, again, I think we sort of think about investing into companies, not in their shares, but actually investing into businesses and thinking about, what is this business worth to us? Suppose if you're to own the whole of it, right? So what is sort of the cash flows that you can receive from it over an extended period of time? And so it's a function of the growth in the business, the economics in the business, the capital efficiency of that business. So you've got to put all of those things together to get a sense for what the intrinsic value is. And I would say that usually it's not a point estimate, it's usually a range. And so what you want to make sure is that you're buying significantly below your estimation of that intrinsic value, because there is a range to it. There's some sort of margin of error in there as well. And so what you want to make sure that you're buying at enough of a margin of safety from that, so that even if you're wrong by a little bit, it's unlikely to impact your future returns. And so that's essentially what we try to do.
So since you emphasized on the word margin of safety, let's talk about where a strong margin of safety is available. It's there in steel companies, cement companies, hospitality, aviation stocks, because these stocks are beaten black and blue. Some of these stocks are trading at valuations which they've never seen in their entire listed life. You've not historically bought into cyclicals or deep economy related stocks. Are you looking at reorienting your portfolio?
So see, I think we generally had a bias for investing in companies where there is a predictability of that business over a period of time. There's enough amount of resilience in their businesses. And so that's our preference. It doesn't mean that there is not a lot of value in other places as well. But I would say that even within the areas that we look at, there are certain things where that their immediate impact of the business is quite big. So, say financials or automotive, there is an impact to the business. But if the prices have fallen so much that the margin of safety emerges, there is an opportunity in there as well. But I would say, by and large, our preference had been to invest or to look at companies where there is enough resilience that they could do well even during periods of lockdown. So we had many companies that were able to operate during the lockdown phase and still had revenues and earnings and cash flows. Or the second bucket, which is companies which may see some impact during the lockdown, but will see a very quick rebound to the levels where they were before. So that's generally been our preference, especially during the first month or two when there was a steep correction across the board. So what you found was that irrespective of the level of impact to the business, everything corrected by the same 30, 40, 50%. Even the companies whose businesses have not seen much of an impact from an economic perspective. And so that's a mispricing, and that's a much easier one to take advantage of. But over a period of time, I would say even the bucket 3, which is the companies where businesses are impacted today, if the prices have really fallen way below, there is good margin of safety in those.
Sumeet, if I look at your current portfolio, you own names like Webhub Global. There's a large exposure to Apple, recently listed digital advertising company, India Nivesh, which in a sense is a B2B platform. What is the thinking behind aligning your portfolio towards some of these new age businesses?
Yeah, I think the future for these companies is quite bright, right? So in the sense that you've seen some impact in their business, in the current quarter, but if you've done any sort of valuation exercise, one quarter only contributes a very small, fraction to the overall value of those businesses. And these companies are profitable even during the current environment, right? So maybe you take, some hit on your P&L for the quarter, but essentially, what has happened in case of these new economy type of businesses is that the future has actually come forward a little bit. And so what you anticipated would happen over the course of, let's say, next 5 years or 7 years is probably going to happen in the course of next 3 to 4 to 5 years. And so one example of that you clearly see is that I think people's comfort with transacting online has only gone up. It happened because of compulsion, that when people were locked down, you had no choice but to buy things online. And so, people were able to cross over that barrier. And whether there was a concern around, difficulty in understanding how it functions, or worries about what happens to, credit card information or any sort of digital payment, I think people were able to cross that wall of worry. And once you've crossed that, I think you realize that it's actually not that difficult to transact online. And secondly, it's very convenient. I leave aside the price benefit, but even for the first two reasons, I think a lot of people have become comfortable with that, and many of those habits will continue to go as you go forward. And so for companies like Apple, I think that's a great opportunity because now you have more number of users who are transacting online, and more number of advertisers who would want to acquire those customers, and Apple can play a very important role in making that happen, right? Similarly, a company like IndiaMart, right, which is bringing buyers and sellers together. In the current environment, I think the biggest challenge for most companies is what's happening to the demand. And IndiaMart is a platform that provides that ability to companies to generate demand. And people are willing to pay a price for that. And so I think the importance of IndiaMart in the mind of its customers has only gone up. Yes, there will be some impact in the current quarter or current financial year, but I think in the medium term, their opportunity has only gone bigger. And so that's essentially what we're looking at.
So for something like Apple, are you not worried about what Google can do, because they are the dominant player in digital marketing, and especially for IndiaMart, Amazon has already started a B2B business called Amazon Business, which in a sense connects or creates a platform to connect B2B, buyer and seller. So if the big tech giants are moving into this space, how will the smaller names like an Apple or India Mart survive?
So I think in a digital ecosystem, I think there are rooms for many players, and obviously the large players, have taken a lion's share of the market, but it creates an opportunity for other players to also thrive within that. And so, for example, because the larger players have so much power, and they've sort of reflected that in the way that they price, and so their products are priced that much higher. So if you wanted to advertise on a Google or Facebook, the cost of that is pretty high. And depending on the advertiser and what type of products they're advertising and which users they're trying to attract, it may turn out to be that it's not economical to do that. Your cost of acquiring a customer on those platforms may be very high. And in those cases, Apple can actually play a very important role. First, in terms of identifying the right set of users who are really more likely to sign up for a particular product or service. And then secondly, to find the most cost-effective way of getting that customer. And as a result, the cost of acquisition of that customer through Apple's platform could be cheaper compared to what you may get on a Google or a Facebook. And so I think there is a room for a player like them. I think even globally, you've seen a company like Trade Desk has done phenomenally well in the US by essentially finding opportunities like this for advertisers. And we think India will be no different from that.
Sumeet, you've invested in NBFCs in the past, especially names like Chola. What's your view there? Given that currently NBFCs are in a spot of bother, they're not able to raise capital as freely as they were, and with the exception of, let's say, Chola or a Sundaram or Bajaj Finance, a lot of other NBFCs are struggling. So if source of capital or source of fund has dried up, what will happen to their growth? What will happen to their balance sheet?
Yeah, so I think it's a challenging environment for financials as a whole, right? Because you still probably haven't seen the worst of the crisis. It's only after the moratorium 2 gets over, then you'll start to get a sense for how many of those people have taken moratorium actually end up repaying you, right? So I think in some ways, I think that problem still exists for financials, and I think they have to reckon that. Having said that, I think any crisis like this really sort of starts to separate good players from the bad ones, and that good to bad separation will only sort of accelerate or get heightened in an environment like this, and it sort of manifests itself in multiple ways, right? So one is in terms of getting access to funding, as you pointed out, and I think you'll find that the good players will still be able to raise money and still be able to raise it at a reasonable cost, versus many of their competition will have issues with both availability and cost of funding. So that's sort of one place where you will see that separation will start to widen. The second way, and probably an even more important way that manifests itself, is in terms of the better underwriting skills, right? So when things are going well, it doesn't make as much of a difference because the economy is good, people have cash flows, they're repaying everybody. But in an environment like this, I think companies who have done a superior job in terms of underwriting will actually end up doing better. And I guess,
but private banks have been the real darlings for the market. I mean, that's been one mega trend which has worked wonderfully well for investors. But do you think now banks, they run the risk of underperforming? And I'm simply asking you this not based on the evidence of fundraising which is now there. From HDFC Limited to even Kotak and now ICICI Bank, all of them have indicated that they are looking at raising capital. And you typically raise capital when you feel that the near-term uncertainty is going to be dawning on us.
So I mean, in general, for most businesses, but especially for financials, I think what sort of really matters is sort of having a strong balance sheet, right? And the strong balance sheet is a function of the equity that you already have, right? And that's the important part, right? It's not the equity that you can raise today, because if you're raising equity today, it's going to create a lot of dilution to existing shareholders. So it's the ones who already had the reasonable amount of equity and equity beforehand, and so they entered the crisis with strength. And I think those are the players who will be able to survive this. Secondly, if your business has enough of a cushion in the way that you operate, right? So, for example, if you have enough of spreads and enough of pre-provision operating profit, you have the ability to take a hit on that in terms of credit cost. And so you find that the companies which had differentiation, and as a result, they could have those sort of higher spreads and higher pre-provisioning profits, they have the ability to absorb a little bit higher credit costs than normal, and which itself could be limited because of their better underwriting. And if you have the ability to do that, you can survive through the current crisis a lot better compared to other players. And when you come out of the crisis at the other end, you will find that the competition is actually weakened out, and you can actually then take advantage of any growth that stays after a year or 2 years as you come out of this crisis. And so an example of this, I think it's on the NBFC side or HFC side, is one of our largest holdings in the financial side, which is a company called as Aptus Value Housing Finance. It's still a private company, so it's not in the market. But I think if you look at the position in which they entered the crisis, they had ROAs of 6% plus. They had leverage of just about 1.1x, and they had pre-provision operating profits that were wide enough that even if their credit costs, which were 0.3%, even if they went up 3x, 5x, or 10x, they would still be able to do just fine, right? So if you have companies with such strong balance sheets and cash flows and economics, they can survive that situation significantly better than many of the marginal players. And those marginal players either may go out of business or may find it very difficult to grow when the crisis gets over. And so the stronger players end up becoming stronger. I think that's a theme that you've seen in pretty much every crisis. And we think that's the same theme is going to play out this time as well.
So one works with an assumption, Sumit, that digital economy is going to be an outsized gainer, whether it is on the front of telemedicine or even data or even for that matter, e-commerce. What is the best way to participate in this? Should one buy Indian IT companies, which in a sense are a proxy to give digital services to the world? Should one buy into frontline telecom because those are the companies which in a sense will fulfill India's data binge? What's the best way out?
I think it depends from investor to investor. I think so if you have large amounts of money and there's a challenge to deploy that, perhaps telecom is a good way to be able to do that. As you've seen in the case of tremendous inflows that have come into the Geo platform. Right? So if you have large amounts of money to deploy, I think you would look at opportunities like this. But I think if you're managing a smaller pool of capital, or if you're an individual investor, I think for you there is an opportunity also in some of these niche ideas, which have the ability to grow much faster than overall market, right? So, for example, I think Apple's management has come on record and said that they feel that they can grow the business at 25% annualized for the next 5 years. That's a pretty tremendous outlook in the face of the challenges that we're seeing today. And very few large companies will be able to deliver an outcome like that. And so I think the smaller companies, I think, provide you with the ability to capture higher growth, and in some cases, it leads to a multiple re-rating as well. So I think therein lies the ability to generate outsized returns over a period of time, which may or may not exist in some of the larger companies. But again, I think it's sort of horses for the courses, right? So for the different investors, it's a different set of challenges and the problem they're trying to solve.
Well, Sumeet, fantastic to have you on ET Now. Thank you so very much for joining us. Stay safe, my friend, and certainly hope to see much more of you going forward.